Welcome back, guys, to MMGinvest. So I just want to show you guys a little bit of the wildfires in California. Keynesian economics says that this is good for the economy because now we could rebuild all of these houses that have been lost. Yeah, right. That capital could have gone towards growing the economy, not rebuilding it, right? That's what an Austrian economist thinks. All right, first of all, not financial advice. Consult your financial advisor. I'm not your financial advisor. Stocks extremely volatile, extremely risky. Do not invest in anything you're not willing to lose or lose sleep over. Have your stops in place, emotions out, and talk to your financial advisor before doing anything. Go to my website though, and it could help you with research data, and then you could use that for your own research and data, and then you could contact your financial advisor and then figure out what you're gonna do. All right, and watch my last video. So let's talk about forest fires for a second. So why are there enormous forest fires in California? Well, because the regulators, right, don't allow for small fires to happen, and some, not, I wouldn't say deforestation, but you have to thin out the forest, because if you let it overgrow, what happens is it overgrows and then becomes extremely dry on the surface of the forest, and it's just it's like a haystack waiting for a spark, and that's what's happening in California. And and they're also cutting off power on purpose. It's almost like Venezuela over there. So how does that relate to the financial markets? Well, first of all, it's not good for the California economy. It's the seventh largest, I believe. It's probably falling though, in the world. But here's the thing. Remember the derivatives and all the debt I showed you guys on the balance sheet of the banks? Well, and same goes with the stock market with asset prices, because we have a huge asset bubble. We have an everything bubble. Everything's overvalued now. Homes, cars, you name it. And stocks especially. And what happens is, if you don't let the free market, do its thing and correct malinvestment, and you have central banks that try to prevent this, and then they print money, and then they let the malinvestment metastasize and grow. It's just like the forest overgrown. So you'll prevent fires for some time, right? Just like California, you'll prevent forest fires for some time. But then the forest overgrows so much, and the malinvestment, right? The the malinvestment, the bubbles, they grow so big that all it takes is one match lit, and the entire thing burns down to the ground. You see, in the natural environment, you're going to get fires all the time in the forest. All the time. From lightning strikes, you name it, right? And that's normal. It's part of nature. And the smaller trees or the dead trees, the dry stuff, right? It burns away. And then the forest regrows stronger every time. Well, same goes with markets. That's how the free market works. The free market works just like nature. It's survival of the fittest. Uh, and with a free market, the malinvestment. So this is how the free market works. You wouldn't have people investing in WeWork. You wouldn't have people investing in Beyond Meat. You wouldn't have people investing in Uber. You wouldn't have people investing in all these tech giants that really aren't even tech giants. They're just repackaging with technology old things, like Uber. I mean, we've had taxi drivers. We've had people carpooling prior to Uber. They just created a internet platform on top of it. Before Facebook, we had MySpace. Before Amazon, there was the Sears catalog. Before what else? Before Beyond Meat, we had real meat. um, and we had vegetables, right? You could just it's just repackaging the same things in a different way and using technology to make it more convenient. Does that mean these companies should be the largest companies in the world with like almost a trillion in market cap? No, it's a bubble. That's all it is, guys. Um, Same with Lyft, like Uber. Anyways, where am I going with this? The free market wouldn't let these companies get as big as they are. They wouldn't let Amazon get as big as it is. None of that. A lot tax subsidies also help. The taxpayer does help build these giant corporations, but the free market wouldn't allow malinvestment, artificially low interest rates, because the free market would make the rates go higher much sooner. So therefore, people would actually have to be responsible with investment, and they wouldn't, you know, put out loans and fund just anything out there. You would actually, your company would actually have to make a profit. Tesla hasn't made a profit. Amazon just recently made us a profit in like, it's been like 10 years. Um, a lot of these companies, and the only reason they just made a slight profit is because they've grown so big and had it so easy. But believe me, it's a bubble, and once the bubble pops, none of these companies are going to be profitable. What WeWork, all the recent IPOs, none of them make a profit, turn a profit. All they do is lose money, and they're IPOing so they could unload, so they could raise money, more money, and then unload their shares onto gamblers and speculators. And but you know what? That's coming to an end as of late. So that's the first sign, one of the first signs that this economic expansion bubble euphoria is coming to an end. So I am going to talk about charts for a little bit, but let's talk about the news first. So Morgan Stanley growth stock crash has begun. And just another red flag, right? The growth stocks, the FANG stocks. You guys could read this. It's on Zero Hedge. I just want to talk about this for a second. Global authorities brace for worldwide protein shortage after a quarter of Earth's pigs wiped out. That's crazy. 1/4 of all the pigs in the world are wiped out from African swine fever. I'm not a big fan of pork, but bacon's delicious, and I like ham. I'm not a fan of sausage. All right, the Feds. Well, I do like Browers. Anyway, the Fed's not QE and how we are playing it. So here's another article. Essentially, in a nutshell, I mean, they're sort of thinking what I'm thinking. So we had that huge crash in the beginning of the year. It was like a 20% crash, right? And usually once it's over 20%, that means it's in a bear market. But here's the deal with the not QE repos and the market. The market just tested all-time highs Friday. Tested. And like I said, guys, we might get a melt up. But if we do, okay, so if the market breaks up, it makes new all-time highs this week and starts running up, then I think the melt up is going to be extremely short-lived. And the only reason it'll do that is because Jerome Powell was an uber dove, and he's signaling towards QE, even though they're already doing it technically. And maybe he cuts rates 50 basis points. Then we'll get the melt up like starting this week coming up, right? But if we do, the market's extremely overextended, And I think it'll be short-lived. And that'll put in possibly the top. So we might have the market melt up for a few more weeks, and then that's the top, that's it, and then down she goes. Or, well, the best thing for the melt up so it could last longer would be for the market to pull back now towards the end of this year, and then more QE, then cut to zero interest rates, and then more QE. It's the only thing they could do. And then we might get a extended melt up that could last, who knows? I don't know. For months, half a year. At the most, like a year or something in 2020. And then Trump could get reelected, right? But I don't know. I wouldn't count on that because the repo market, you have to understand something. In 2006, the Fed raised interest rates to 5%, somewhere around there. And what happened? The same thing happened in the repo market. So what's the repo market, right? It's the interbank lending, the banks lending to one another. So I'm speculating. I don't really know. But why would the banks stop lending overnight to each other? Because it's only overnight. That means someone's assets went bad in a big way. So maybe a bank blew up, like Deutsche or something. I don't know. And the banks are so nervous about it, and it's so systemic. Like, remember the forest fire analogy. You'll light one tree, and the entire forest is overgrown. The entire forest burns down. And if a bank went under and it's serious, then the banks won't even risk lending overnight to one another. Or let's say for lending for even a few days or a few weeks, they won't even risk it. And it's likely because of their extremely large multi hundreds of trillions in derivatives exposure. And not just that, just because the Fed have raised interest rates a little bit in 2018 and 19, what that did is the bank reserves might have fell and they don't have any cash. They're just levered up with debt and they're invested, right? So the Fed is the intermediary right now, and they're doing... Okay, so a few weeks ago, they said this will be temporary, just 2 weeks. Well, now it's for 6 months, and it's 60 billion month over month. Every day now, you see them injecting or funding the repo market like 120 billion or 130, I think it was a couple days ago. And then, yeah, they get the money back, but at the same time, the Fed's balance sheet is exploding. It's over 200 billion. 200 billion. It's almost at a quarter of 1 trillion. That's insane. That's more than the QE, the top of QE during like 2009 after the 2008 mortgage-backed security crisis. So I feel like the mainstream media and everyone's downplaying this, but there's a huge liquidity crunch. There's just not... There, you have to understand, the more money they printed and the more malinvestments and the more loans that were put out because of prior QEs and low interest rates creates a massive debt bubble that needs to be serviced, because on all debt there's interest. And when there's interest on the debt, you have to constantly keep injecting money into the system, because if you don't, then the debts come due and the chickens come home to roost and the house of cards comes down. So so for a decade, near zero interest rates, right? And then the first half of the decade, they were printing money. So what did that do? Endless malinvestment, and created through fractional reserve lending, the banks. You have to understand what that is. Maybe I'll do a video on it. But like, you only need $1 to lend out $100. So the banks essentially make money out of thin air as well, not just the Fed. The Fed makes money out of thin air. The banks get the money, and then with their reserves, they could have a multiple of like 70 or something insane of that money, which is makes 70 times more money into the system, or something like that, a high number like that. So when you go to get your home mortgage, the bank only needs $30,000 on their balance sheet to lend you $300,000, and then you have to pay back the $300,000 plus interest over time. So how are you going to pay that back if the Fed raises rates and they stop injecting money into the system? How are you going to pay that back? Because there's going to be less money in the overall system, and then people get laid off. See what I'm saying? None of this works. It works in theory through models, but it doesn't in real life. That's the problem with the entire global economy. This is global. It's not just the U.S. You can't create growth with money printing and debt. It's that simple. All right. So you guys can read this title. He's counting on Trump losing the election, and he endorsed Elizabeth Warren. So Warren is the elitist puppet, the next one they want. And they're probably betting on the fact that the market's going to dump and Trump won't get reelected. And if that happens, we're going to have some serious problems. Like, it's going to be bad. So Mish, pondering the collapse of the entire shadow banking system. The shadow banking system consists of lenders, brokers, and other credit intermediaries who fall outside the realm of traditional regulated banking. So he's talking about all the... Okay, so the Fed didn't just create a bubble in the U.S. It created a bubble globally, and then the rest of the central banks and the rest of the governments around the world started doing the same thing. So the repo market could also be a problem with international banks, like Chinese banks and European banks. So here's the problem. The Fed might not be able to stop the repo market from blowing up and everything because all the banks are so intertwined globally now. So the Fed can't bail out the world. The dollar would just go to zero pretty quickly. That's what we're looking at. All right. So 3 things I learned in Washington. Central bankers aren't sure what to believe anymore. So someone went to Washington. As the world's central banks and economic policymakers convened in Washington over the weekend for annual meetings of the IMF, IIF, and the World Bank, there was a distinct lack of conviction in the air. Globally synchronized slowdown, trade wars, political uncertainty, resistance, ultra-low interest rates have ground down most investors' and policymakers' belief in prevailing economic or market narratives. So the most interesting conversations were about transitions and tail risks. What are the long-term implications of the negative rates? How disruptive is digital money? What does the greening of the financial system mean in practice? The greening is probably like regulations for emissions, climate change. Central banks are wrestling with major challenges. These people have no idea what the hell's going on. You know what? I think they could control the system, and they might be able to create a soft landing, but they might not. I mean, these people are just all Ivy League. They never ran real businesses in the world, most of them, and they're just all puppets to Wall Street and banks, and Could monetary theory MMT actually save us? No. What it can do is turn us into Venezuela. That's all it is, guys. It's just repackaging Weimar Germany style money printing and inflation eventually. and I've talked about MMT plenty of times. This is what I'm worried about. Trump loses, Warren wins, we're going to get MMT. And the U.S. it's going to be third world quick. Like, it's going to happen quickly. So, it's going to happen one way or another, but I'd rather have it happen slower than quicker, because when it's quickly, it's just dangerous going outside of your home. And corruption it'll just be disgusting. Although, again, the flip side of that is if it's Mad Max, they lose complete control of the system. Alright. So, let's take a look at some charts. I'll talk about Bitcoin as well. Alright, so stock market tested all-time highs. VIX is almost all the way down at yearly lows. So what happens when it falls to yearly lows? It'll spike up soon again. The dollar did rebound like I said it would. And I also said that the market's probably going to make new all-time highs in the last few videos. So, if you guys pay attention to what I say and, consider it, then you guys know that I'm fairly right most of the time. The short term, that's harder, of course. But, let me close some windows here. Slow. Alright, let's get back to the charts. So the dollar did bounce off my blue line, just like I said it would. Now, is it going to keep going up? Is it going to make new all-time highs? I don't think so. Although, if the world starts falling apart, then we might get a spike in the dollar for the short term. But for now, I think the dollar is under pressure. I say let's wait. Let's see what happens this week, because we have the Fed minutes coming up Tuesday and Wednesday, right? So, essentially, I think that's the most important thing right now, is the FOMC this Tuesday and Wednesday. And we're going to find out if the market's probably not going to go much higher tomorrow and Tuesday. It might pull back, and it's actually better. So if the market pulled back down to the S&P 500, this is the S&P 500, pulled back to 2940, let's say, or 50, and then bounced again or rebounded and then made new all-time highs, then we could have a stronger and longer lasting melt up. But it all depends on what Jerome Powell says this week coming up. The market could dump. If he says something stupid like, hey, we're not going to lower rates anymore. This was it. This was the end of the midterm cycle of lowering rates because of the global slowdown. But I don't think he's going to do that. I don't think he's that dumb. I think he's going to be a super dove, but he's not going to say anything. This FOMC, he has to play it perfect. He has to be a dove, but he can't be too much of a dove because if the market does go and make new all-time highs, the melt-up could be very short-lived. So it would actually be better if he was a dove, but not too dovish, and the market pulled back again. And then the next FOMC, that's when he shows all his cards and says, all right, guys, we're going to do QE again and blah, blah, blah. And then, or maybe he won't be a dove, and then the market takes another huge hit back down to 2,600. And then from there, they try to get the market back up. The problem is, the higher this market goes and the more overextended it becomes, every pullback and dip is scary. And it could be the last one. The next pullback, you don't know, because it takes much more money and more lowering of the interest rates and QE just to get the market back up to where it was. So that's why they freaked out. That's why Mnuchin freaked out back here and he said, listen, guys, the banks are fine. And everyone looks at each other. No one said anything about the banks, Mnuchin. So, I say let's wait till Tuesday and Wednesday, see what happens. Either way, I wouldn't be long right now in the equities and stock market. I am long gold and silver stocks and ETFs. So let's take a look at a few more here. Let's take a look at the FANGs. FANGs broke up to the upside, so this is bullish. This is a 3-day chart. The Russell 2000. It's testing my blue line. So here's the thing. If the Russell breaks down tomorrow and Tuesday and Wednesday, then the rest of the market will go with it. It's that simple. Just want to talk about Tesla for a second. Tesla had a huge gap up rally. Like every short just got wrecked. Good thing, because I was going to short back here, but I couldn't find any shares, so I got lucky. I would have been stopped. Well, I don't know if I would have been stopped out because of this huge gap. I probably would have lost that position. But for strategy, how to trade, I talked about that a little bit. I'll make another strategy video for you guys on trading. But watch my last 3-hour-long video so you guys learn something. All right. My last video is very important. If you're going to invest in gold, silver, physical, and stocks, you have to watch that video so you understand the big picture and you understand strategy. It's the most important thing. Tesla, I'm looking to short it anywhere up here from like 330 to 350. I don't think it's going to break higher. Even if the stock market melts up, something's going to come out because Tesla is, in my opinion, they have competitors coming out this in 2020 like no other, and way better quality, everything. And then there's just everything else about Tesla that I don't want to get into, and Elon Musk. All right, let's talk about gold. Let's look at the gold chart. So gold's breaking out bull flag on the weekly. It's on a 7 count, then an 8, and then a 9 count, which was downside 9 count, which means on a 9 it should rebound and then go back up, make new all-time highs. Guys, I'm still bullish, and I think it's, and another reason why I'm bullish is because of the FOMC coming up. Like I said, he's going to be a dove, and he might actually be really nervous when they start asking him about the repos, because it's going to come up. Technically, the 4-hour looks, there's a 9 sell on gold. So maybe Monday and Tuesday, it might trade back down to 1500. But as long as it's above 1500, I'm long. All right, guys. Even if it breaks below it for like a day or something, like 1498, I don't care. Like, you have to understand these even numbers. You always give them some leeway. But I'm still holding. All right, long, especially prior to this FOMC. The 12-hour chart's on a 6 count, so we could have 7, 8, 9, 3 more candles on the 12-hour upside until like Wednesday, and then we'll see what Powell says, and that'll be an important day to decide to hold your position or to take profits. Because we bought in last week, right? And not last week, we bought in right at the bottom of this dip. I just made a video again. Yeah, we bought right back down here at 1466, 1480, that region. I told the private members that I made a video and I said we're long, and it's been working out pretty well with the ETF and trading them and some of the stocks as well. All right, guys. Silver. Silver looks less attractive, but it did run up to $18, which is a big deal. Here's a 12-hour. It's also on the 6 count. The daily. silver just needs to get above this Reddy Shimoku cloud, Kumo cloud. If it could get back above, this is gold. Damn it. Hold on. All right, here we go. Here's the weekly on silver. Weekly is neutral. Daily is on a 9 sell. See, that's the problem with silver. It's on a 9 sell on the daily. Gold is not. So silver might lag gold if gold rallies, right? From here on, back up to test 1600 and maybe a little higher. So silver is going to lag. But it'll only lag. But, you know, when you get a 9 sell, it could be 1 to 4 day pullback. So it might be just 1 day tomorrow. The 4 hour is also on a 9 sell. So, you know, tomorrow we might get a little pullback on metals. If it's not, if the bankers, if they don't, you know, smash it, then it'll be all right. I don't think they will. They probably won't be able to. And if they do, I think buyers are going to step in, especially prior to the FOMC Wednesday. All right, guys, smash them likes, leave anything in the comment section. Please share my videos. It's the only way my channel grows. Until next time.